Hello and welcome. Today, we're going to take a journey through the world of real estate finance. And we're going to start with something we all know, your own front door, and then zoom all the way out to see how that one door connects to this massive global system of investment. Let's get right into it.
You know, it's a pretty wild question when you think about it. That giant stack of papers you signed for your first mortgage, well, it turns out that's just the very first link in a chain that stretches across continents and all the way to Wall Street. So today, we're going to follow that chain, from the personal to the planetary.
Okay, so let's start at square one, with the dream of owning a home. For most of us, that dream only becomes a reality because of one key financial tool, the mortgage.
So, what exactly is a mortgage? Well, the word literally comes from Old French for a dead pledge. Kind of grim, right? But it makes sense. It's a loan where the property itself is the collateral. If you stop making payments, the pledge dies, and the lender can take the house. It's the absolute fundamental building block of the entire real estate market.
Now, right when you get that loan, you've got a big choice to make. Are you going to go with a fixed-rate mortgage, an FRM, or an adjustable-rate mortgage, an ARM? With a fixed rate, your interest rate is locked in solid for, say, 30 years. It's super stable, you always know what you're going to pay. An ARM, on the other hand, well, it adjusts. It moves with the market. When interest rates are low, hey, you save money. But when they go up, so do your payments. It's really that classic trade-off, security versus potential savings.
So, you've signed the papers, you got your loan from your local bank, but that is not the end of the story, not even close. It's time for our first big zoom out to see the massive system that's working just behind the curtain.
I mean, really think about it. A bank lends you a huge chunk of change that you're going to be paying back for decades. If they did that for everyone in town, they'd run out of cash like super fast. So where does all that money keep coming from? The answer is something called the secondary mortgage market.
You know, this system didn't just appear overnight. It was built piece by piece, usually after some big economic crisis. It all started back in 1934 with the FHA, which basically insured loans, giving banks the confidence to lend money. Then in 1938, you get Fannie Mae. Its job was to buy mortgages from the banks. And this was a game changer. It meant banks got their money back almost immediately so they could turn around and issue more loans. Freddie Mac came along later to do a similar thing, just to get even more money flowing. These guys basically act like wholesalers for mortgages, creating this constant river of cash for people to buy homes.
All right, so we've seen the system that makes homeownership possible. Now let's totally switch our perspective. We're going to stop thinking like a homeowner and start thinking like an investor. Maybe even an entrepreneur.
This right here, this is such a crucial mindset shift. I mean, buying a stock can be pretty passive, right? You buy it, you hold it. But buying property to make a profit, that is an active job. You're dealing with tenants, repairs, maintenance. It's not just an asset you own, it's a little business you have to run. So, what is the secret weapon for pretty much every real estate entrepreneur? It's this one word, leverage. It simply means using other people's money, usually a bank's, to buy a much bigger asset than you could ever afford with just your own cash. Now, this can totally amplify your potential returns. But, and this is a big but, it also amplifies your risk. It's really the engine that makes real estate investing go. And thinking like a business owner means you need a strategy. First, you gotta figure out your price range. What can you actually afford with your cash, plus whatever financing you can get? Next, it's all about location, location, location. You have to become an expert in that local market. And finally, you have to be really honest with yourself about your skills. Managing a 20-unit apartment building is a whole different ballgame than renting out a single-family home. You've got to match the property to what you can actually handle.
Okay, but what if you want all the financial upside of real estate without the 2 a.m. calls about a leaky toilet? Well, this brings us to our next level of abstraction, a way to invest in huge properties, basically from your laptop.
Welcome to the world of REITs. Think of a real estate investment trust as a company that owns and runs big-time properties, like shopping malls, office buildings, or giant apartment complexes. And here's the cool part. You can buy and sell shares in a REIT on the stock market, just like you would with any other company. It's how Wall Street basically opened the doors of large-scale real estate investing to everybody. Now, this whole REIT model, it was pioneered in the U.S. way back in 1960, and for decades it was pretty much just an American thing. But then, in the early 2000s, the idea started to spread like wildfire, first to Asia and then a few years later to Europe. It's become this new global standard for how people invest in real estate.
And this brings us to our final and biggest zoom out. We've gone from a single mortgage to a national system to these publicly traded funds, and now we're looking at the entire world of property.
So why are investors suddenly looking all over the globe? Well, it boils down to two big things: diversification and higher returns. By investing in a bunch of different countries, you spread out your risk, right? A housing slump in one part of the world might not affect another. Plus, as the markets in their own countries start to slow down, investors are looking to these rapidly growing economies for a better shot at bigger profits.
So let's look at two of the heavyweights, China and India. Both are just exploding with growth, but they offer totally different stories for an investor. In China, you have this breakneck urbanization, just massive rapid expansion. But the legal system can be a little murky. Over in India, you have a population that's about to be the world's biggest, a much more stable legal system for property rights, and a huge number of English speakers. They both have these incredible opportunities driven by just insane demand, but they come with very different sets of risks.
And hey, it's not just about China and India. Investors are looking everywhere. You've got Brazil with its enormous economic potential, Argentina with a recovering market, Vietnam, which has relaxed its rules on foreign ownership. You even have a tiny country like Montenegro, attracting big money for its beautiful beaches and ski resorts. The hunt for the next big opportunity is truly global.
So we've come full circle. We started with one local loan for one local property, but we've seen how that one little action is plugged into a global flow of money that is constantly moving, constantly searching for the next big thing. It really leaves us with a final thought. While every piece of property has a physical address, the money that buys it has none. The only question is, where is it going to go next?